So we started and we did I know we did exercise 1-1. Where's the Excel sheet? Hmm, where's the Excel sheet? Yeah, good. So you guys see the screen, right? We did the exercise 2-1. We also did a 2-2. We completed a 2-2. 2-2 A. We get a goodwill because we pay more than the value of the what the company. On the B part, we get a gain on the business because we pay less than the value of the what the business. So if you look at 3 here, also combination of they are paying cash at the same time they are also giving the what the common stocks. Remember, the consideration can either be the cash or maybe common stock or the debt security or all the above. All the three can be the consideration. So if you look at this one here, just try it company acquire the asset. See, except they are not acquiring the what they are not acquiring any of the what the cash and assume the liability of the strong company on January 2021. As the compensation, just try eight company give the cash, shares of 15,000. So they are giving them the shares of 15,000 of eight stock. 7,500 share of eight 10% preferred stock. And they're also giving, so they're giving two, even in terms of the stocks, they are giving them the two type of the stock. They are giving them the common stock at the same time the preferred stock. And in addition, they are giving them the cash of the what the 25,000 cash is given what to them as the cash 25,000 to the strong stockholders of the strong company. On the date of the acquisition, just try eight company stock at the following characteristics. So the common stock at the par value of the $10, but the fair market value is what 25. So this tells you that there's a what $15 more. There's $15 as a what the other contributor capital because the market price is what is higher than the par value. But when it comes to the preferred stock, the par value is equal to the fair value. And this is the strong company, their balance sheet before the acquisition. They have the cash of 85,500. The fair value is 85,500, 82,500 because it's a what? It's a cash. Account receivable here, the net of account receivable. So the question is, what is the actual account receivable? Because this is the net. This is the net that give at 110. So we have to know what is the actual account receivable. And the market value of that account receivable now is 99,000. Inventory as a word, LIFO, this company use the LIFO method. They have 137,500, but in the market, the is value is a what 164,000, 5,000. When it comes to the land that has increase in the market value is more than the book value. PPE or building and equipment after the depreciation also is the same. There's no change. The total asset now is what 1,193,500 as compared to the book value of 1.1 million. The when it comes to the current liability, there's no change. When it comes to the bonds payable, there's an increase. I think the difference maybe 50,000, I don't know, or maybe 22,500, something like that. The common stock is what 389. Remember, we don't care about this common stock because we are buying the equity. So other contributor capital for this, we don't care. Retained earnings, we don't care about retained earnings here. So prepare the journal entry on the books of just try it with the parent company to record the acquisition of the asset and also assumption of the what the liabilities. So we know that they are buying everything except that there's no cash. So they are acquiring their account receivable. They are acquiring this company account receivable. Now the question is, we have to find out what is the original account receivable. We want to know the original account receivable that gives them 110. So we are going to take 110, the book value, and add the allowance of the 5,500 here. That will tell you the original figure or the value of the account receivable before the word acquisition, which gave you I'm trying. Is it one? Is it 500? Am I right? Those with the calculators. Okay, somebody put it there. Oh, I hope it's okay. I think so. I don't know because this is 5. Yeah,
Yes,
I
that's
think
fine.
so. Thank you. Then we have the inventory here. This company is using the LIFO. You don't need to put the LIFO anyway. So let me ask you, which one do we have to pay? Do you have to pay the book value, record it on the book value, or the fair value?
Fair value?
Fair value, which is equal to the what? 275,000 here. Now, somebody will ask, Professor, why didn't we record account receivable on the fair value? It's because we want to know the original receivable, then we can create the allowance. Once you create the allowance, it will go back to the what? To the value of the 99,000. Then we have the what? The land. The land is equals to, we have to, you said we need the what? So the land is,
Then the land 275,000.
yeah, that's what I was looking at. So this one is rather 275 is for the land, right? Then we have the what? The next word, PPE. So plant and equipment. The net of PPE, which is amounting to 572. Then we have the what? Now we have the what? The liabilities. So we are going to create this one. We are going to create the what? The allowance, because of allowance for doubtful account, which is equals to 115,500 of the receivable, right? Less the market value of the receivable, which is 99,000 here. So how much is the allowance here? Is it 16,500? Is it good? Please.
Yes, that's correct.
Good. So which means that you see, and that is when you subtract this one, right, from this in our new balance sheet, if they want the account receivable net, is the difference between the two here is equals to this is equal to the what? 115,500 minus the what? The 16,500, and we are going to get the what? The value of the 99 that we are talking about, 99,000. It will be equal to the market value of the 99. It will be equal to the same amount of the 99 in the what? In the market value. But you don't need this is just to prove that we recorded account receivable in the net, which is the 99,000 here in the new balance sheet. Then we have the what? The liabilities. So we have the current liability was given to us. The market value of the current liabilities, or the fair value, was given us 137,500 here, 137,500 here. Then we have the what? We exchange it. We have the bonds payable here. So we have the bonds which is the 5%. You can bring the bonds payable. The bonds payable, if you look at the actual amount of the bonds payable that was given to, where's the current liability? How did I get now? It should be more than that.
It's 137,500.
Yeah, I forgot a 3. So 137. Okay. And then the amount of the bonds payable, if you look at the bonds payable, is a what? 225. So 225. This 225 is due to the fact that there's a what? Premium on the bonds. Premium on the bonds. Premium on bonds payable, which is equal to the difference between the market value 247, 500 minus the 225. So how much the premium? How much do we have in the premium?
$22,500.
Thank you. 22,400, right? So 22,400 or 500. Okay, 22,500. So this is a premium on the bond. Now we are giving them the common stock. So we are exchanging this one with the common stock. So we are giving them the common stock here, which is equal to the common stock. We have to, I will do the premium, the preferred stock is the same, 15,000 shares times the par value of our share. The par value of our share is what? 2.5, right? The par value of our share, the common, he said it's a what? $10. So $10 is the par value. Can somebody do the math for us? Then we have the
150,000.
150,000. Okay. Then we have the what? The preferred. uh, preferred stocks, which is equal to, we are giving them 7,500 of the preferred stock. 7,500
Professor, why we
times.
did a premium on board 2 times?
It's
Premium
what?
on bonds?
Oh, I did it 2 times?
Yes.
Hold on. Oh, no. When I was tapping. Yeah, it's a tapping mistake. Let me bring this one here. $1,700 times the what? $100. Well, the par value is 100. So multiply by the $100 here. If I'm not mistaken, is it 750?
Yes, it is.
Professor.
So 750,000. Then we have the other contributed capital. So this is the other contributed capital here. Which is equal to that's $25 minus the what? The $10 multiplied by 15,000 shares. Multiplied by 15,000 shares, yeah. So how much do we have?
225,000.
225,000.
Yes.
Thank you. And then he said we give them what? Cash as well. We give them cash as well. And how much cash did we give? He said, I think 25,000 or something like that, right? Yeah, we give them cash of the 25,000. Okay. Now we have to determine what is a goodwill. So there's 2 ways of doing it. You can do it, and then I can actually use here because I'm doing the Excel. Let's see something. This is equal to the sum of the total here. This is equal to the sum of this one. So there's a difference. This is bigger than this one. Therefore, it's a goodwill. So the goodwill is equals to this minus this one here is equal to the goodwill. Is it okay? Now I can clear this one. But remember, you don't need to bring the total here. So, or you can put it if you want, you can, this one is equals to 1,551,500. Let the debit side of the word 1,500 here. And that give you this, so we can now take delete this one here. Any question, please, on this exercise? Any questions? Any? Or you can, if you don't want to do it the way we have done it. Oh, how? Yeah, because we use the formula. That's why it's gone. If you don't want to do it the way we have done, you can go by the word, the formula to calculate the word, the goodwill that we started here. So one, goodwill, if you don't want the goodwill here, as usual, equal to the word, your consideration that you are giving, less the word, the net identifiable asset, right? Now we know that, so consideration here, we know that consideration is equals to, we have the amount of the consideration, which is equal to the what? To the common stock that you are giving. So it's equal to the 750, which is this one, if you want, plus 375, which is the including the cash that you are giving here. You are adding them up, but it's the same. So I don't want to waste time and then do it. It's the same. It's good to continue. Any question before I continue? Or is that okay for us to continue? Then I can continue. It's good?
Yes, Professor.
Okay. Okay. Now let's go to the this in and the notes. Then I'll come back. Then we can see if you can finish this one. Yeah. So
Oh, I'm so sorry.
I should go back, right?
For the consideration, how do we know that it's that amount?
Oh, okay. So you see, it said we are giving them the stock company as a compensation. Just try each company give the 15,000 share of its common stock. So we look at their common stock here. So we took the 15,000. We are giving them the stock 15,000 times $10. Why $10? Because the par value of their stock is $10. We are also giving them the what? The 7,500 of our preferred stocks. Our preferred stocks, which also has the par value of the what? The $100. That's what we have it here. But when it comes to the common stock, even though we are giving them common stock of 15,000, in the market, our share is high. The price is what? $25, which means that we are getting extra money. We are getting extra money because of the stock market is good for us and our share is up. So we took the $25 of the market here, let the par value of the 10, multiply by the 15,000. So we are giving them three things. One, we are giving them stocks. Two, we are giving them cash. So this is what we are giving them in order to get a company. Does that make sense now?
And what about cash to 25,000?
Yeah, that's why I put it here. It said here, in addition, say here, and cash of 25,000. You see, if you guys remember chapter 1, when you are buying the company, you can give them something called a consideration, right? The consideration here can either be cash or or stocks or debt equity. debt equity here. This, or you can give them all the three. In this case, we are giving them two. We are giving them cash and stock as well. In order to get a company, we are exchanging by giving them the stock and also giving them the stock, cash
Okay.
and stock.
Oh, I see. Okay.
It's
We
good now?
included it. Yeah.
So we are giving them two things, not a three. We can give them one, but we can also give them two or even all the three. Now
Got it.
let's go back. Okay, yeah, so good. So let's go back to this in the notes and finish it. Then we'll come back here. So I'm going back to the lecture notes. Where's the note here? So if you look at the lecture note here, what if, well, there's another treatment of the other related expenses when you are buying the company? There's an extra expense you are going to incur. For example, you have to hire a lawyer, you have to hire the accountant. All these people, they have to pay them, right? You have to hire someone to find the stocks for you. So all these people, we have to pay them. So under the new rule of SFAS number 141, section of the word 105, acquisition related costs are excluded from the word measurement of the consideration paid because such costs are not part of the word, the fair value of the word acquiree and are not asset. So you cannot include, right? If you hire a lawyer or accountant or maybe broker, right, and you pay them, you cannot include that cost as part of the what, the consideration that you are giving. That's not a consideration. It's extra expenses that you are incurred. So you have to treat it what differently from the consideration that you are giving. So this change from the past gap where the purchase method require only the indirect cost to be expensed. Now both the indirect cost and direct cost should be expensed while the direct costs were capitalized as part of the what purchase price. Now you cannot include it. Before. You have to separate them. Indirect cost is treated as an expenses, while the direct cost should be part of the what the purchase price that you are paying. In other words, the consideration. Now we said no, both the direct cost and the indirect cost, we have to expense them on the new rule. Require that both direct and the indirect costs be expensed, and that the cost of issuing security are also be excluded from the consideration of and accounted for as a separate cost from the business combination. Direct costs include the following. The direct expenses include the what? The finder fee, right? The company or the broker that you are asking that they should maneuver around, look around if there's any company that is not doing well and they want to what to sell the company. The finder fee should be what is part of the direct cost, which means that it should come from, if you are paying them, it should come from the what the other contributed capital. It should come from the other contributed capital, not a part of the consideration. Two, if you hire an adversary or the legal lawyer or accountant, all these are the professional fee and it's known as a what direct. Before it's treated as a what you have to capitalize them as part of the purchase price. Now you have to expense them as part of the expenses, but the money should come from the either the retained earnings or the other contributed what capital. Then we have the indirect cost, ongoing cost that cost to maintain a merged acquisition department as well as all other general administrative costs. Any like a secretary's cost, any expenses that is not related directly to the purchases of the company should be treated as what indirect costs. So the journal entry, the next one is the what security assurance costs are the costs assigned to the valuation of the security. You have to ask somebody to value the common stock or the this in of the company. So we have to also reduce that money. That money should come from the additional paid in capital of issue of the stock, if any. Direct costs, we debit the direct expenses, we credit we debit the indirect expenses, okay, the consideration that you are giving. Normally, here you can normally give them cash. Normally you can give them cash. But remember, this cash is not the part of the consideration you are giving. It's the cash you are giving, but it's not a part of the consideration that you are giving. Now, when there's a cost related to the assurance of the stocks, you have to debit the what OCC and kind of what the cash that you are giving. So if you look at a good example here, suppose that S company acquire 100% net asset of the B company. We all know the net book value of the asset is 100,000 by issuing a share of common stock with the fair value of what 120,000. With the respect to the what the merger, S incurred 1,500 of accounting fee. This is a what direct cost. Is accounting fee, lawyer's fee, consultant fee, direct cost. They also have the what consulting fee of what 3,000 here, which is the what other come from the other contributor capital because it's related to the what issue of the what stock. S maintain another department expenses which is going to be incurred every month of the what the 2,000. So we are going to debit the professional fee with the accountant fee. We are going to debit the what the department fee, which is going to be every month. We are going to spend the 2,000. Then the other contributor capital of the what the issue of the stock here, issue of the issue of the stock here of the 3,000, and we are giving them cash of the what the 6,500. Now we already did this one, the journal entry on exercise 2-2, but I'll go over. Is known as the what bargaining purchases. Sometimes you bargain, you pay price below the what the fair value of the what the assets, the fair value of the what identifiable net asset. It means that you get a what a bargain, and the bargain you have to treat it as a gain, and it should go to the what P&L account as a what as a gain. So a gain is reflected in the current earning of the acquiree to the extent that the fair value of the net asset exceed the consideration that what you are paying, the consideration that is what is paid. So looking at this example is the same here. Prepare the journal entry here. We debit the what the current assets because the current asset 5,000. The burden is 15,000. The land is a what 5,000 here. We credit the what the liabilities here. We don't care about the common stock or the other retained earnings. So the gain is a what 6,000. Why? Because your debit is greater than your what your credit, or your consideration that you are giving is less than the what the net asset of the what the company. Therefore, you are paying less money. So it's a gain on acquisition and should be treated as what ordinary gain in the income statement. If you look at another example here, prepare the journal entry on the book. Here, cash will be what? Debit, you are not, it said except cash. We are not buying their cash. So account receivable will be debit. Inventory will be debit. Plant will be debit here. Land will be debit here. Then we have to credit the liabilities, which in this case, the liability amount is, give me 1 second. The liability here is only the what 590. We are giving them cash because it says here, assuming that if the company paid cash, the consideration we are giving is cash. So we credit the cash. So your goodwill is the difference between either the total of your debit here, less the total of the credit, or the consideration minus the net identifiable asset, which we know that the net identifiable asset is the difference between the what this here and this. The difference between these two give us the what the net identifiable asset, the net. Then we subtract from the what our cash we are paying, and then we can create the what the goodwill here. Or you can add all the debit side here, subtract from the what the credit side here. If the credit side is greater than the debit side, that creates the what the goodwill. If your debit side here is greater than your credit side, it creates the what the gain. It means that you gain on the what on acquisition of the company. Any questions, please? So far, good?
Yes.
Okay. So, okay, so let's move on now. So repeat the same. We did this one here, and there's a gain. It's like the homework that we did here. Now, I will do this one, the goodwill impairment. but I want to go and finish the homework before we come to this one, because this is very important. So let's go and finish whatever we need to do here. Then I'll come back. So we can do this one here, and we can also do this one here. Then this one will be maybe next week will be the last one we are going to do. So if you look at this one here, 5 year, asset purchases with a contingency consideration as a liability. So Feel Good Company acquire all the net asset of the Good News Company on December 4. They give them cash. This is the cash they are giving to them. The balance sheet of Good News were as follows prior to the acquisition. We need this one. We planned assets, liabilities, common stock, all this one, we don't care about it. Now, as part of the negotiation, Feel Good agreed to pay stockholders of the Good News 180,000 cash if the post combination of the earning of Feel Good average is a 1,180,000 or more per year over the next 2 years. So what does it mean? It means that Feel Good is assuring the Good News Company, which is now a subsidiary company under the Feel Good Company, that hey, if you guys continue your earnings for next 2 years, if you continue to keep the pace by getting 1,080,000 and above, then we promise you that we are going to give you a cash of 180 for free. For free. We'll give you that money if we are able to keep these earnings coming in every year. Then we are going to give you that money. So it's up to the Good News Company to make sure they maintain earnings of 180 every year in order to be able to receive the money. If in case every year we have to measure and compare the market value to the 180 and see how much the market value of our promise. What is the market value of the promise that we promised them? So the estimated fair value of the contingency consideration was 72 on the date of the acquisition. So every single year we have to see what has happened to the 72,000. Is it going up, going down? If they are able to maintain that money, 1,080,000, of course, we'll give them our promise, the contingency or the promise that we promised them. But if not, we are going to keep the money. That is a rule. We are going to keep the money. We are not going to give it to them. So A, prepare the journal entry on the book of the Feel Good to record the acquisition date on December 31 when they bought the company. When they bought the company. So part A, let's all do together. So part A here, we are getting their current assets. So current asset here will be debit. Remember, this is your debit and credit. Let me put it there. It's not anything. I know you guys know already, but let's do it. Of the 480,000. We also have the plant and equipment. Which is the 720 here. Then we have the we don't know. I'll just leave a space in case if the goodwill. So let's leave this one here in case the liabilities here. We know the liabilities are 108,000. Then we are giving them cash. He said we are giving them cash. We are giving them cash of how much the cash we are giving them? 1,080,000. Okay. Then we promise them the contingency liability. We promise them that we'll give them the liability. So let's see the liability that we are giving. So for and it's the day of the acquisition was 72,000. The value was 72,000. Now we have to look if there's a goodwill or not. So if we add these two numbers, let's do that. This is equal to this plus this one. The credit side here equals to this plus this, or the sum is the same thing. So which means that the goodwill here is 60,000. Good, because the difference here is 60,000. So the goodwill here, we have a goodwill. We are paying extra money to get this company. 1,260,000 minus the word 1.2 million on the debit side. So it means that there is a positive goodwill of the word 60,000. Any question before we go to the B? Any question, please? Good. Now, B said at the end of 2020, the estimated fair value of the contingency contribution increased to 100,000. This one, the liability, contingent liability that we measured, the 180 we measured in the market is 72. It has went up, so we have to record the difference, which means that we have lost because the value is now up. So we are going to credit. Let me leave one space here, and we are going to debit loss on changes in fair value of the contingency liabilities of the contingency. Of the contingency consideration, we have loss. So how much is the loss? The loss is equals to 100,000 minus the word 72,000 here, which, if I'm not mistaken, 28,000 here. 28,000. Then she said, okay, on 2021, the earning did not meet, which means that the company did not meet the what they are earning. So which means that we are not obliged to give them anything. The promise is if they are able to keep it, they make it, we'll give them the money. Here's the case, they were not able to what? To get the money. So we are going to debit the contingency here on the part C. Part C here, we are going to debit the contingency, the liability, because they were not able to meet the money. So we are going to get our money back. Now, the money is 100,000 because the market value, the last time we measured the liability, the contingencies was 100,000. So we are going to record 100,000, that we are going to keep the 100,000, and therefore it's going to be a gain for us. So we gain change in fair value consideration. We have gained this money because they were not able to meet it. If they were able to meet it, we could have given them the money. But here's the case, they were not able to meet it, so we have gained. We are keeping the money. It's a gain to us. It's a gain to the what? To the company. To the gain. So remember, let me put here, this is part C. This is the part B. Any question, please, before we continue? Any questions on the exercise 525? Any question on that? Any?
How we get a gain on 100,000?
How do you get the gain on the 100,000? Because
Yes.
remember, when we promised them the 180, the market value of the 180 was 72. So we recorded a 72 here. But on 2020, when we measured the consideration, it has increased to 100,000. Right? It has increased to 100,000, which means that we lost $28 here, 28,000. On the day, the second year, they were not able to meet. What is the contingency, fair value of the contingency on 2021? Is the 100,000 that we carry on, we measured on the 2020. So that's why we gained the 20 here, because they were not able to meet it. So it's like a gain to us.
Okay.
It's good?
Yes, Professor.
Okay, any other questions? Any? Okay, let's do this one. Now, you see, this one is a reference to this one here. It said, as everything is the same, except that it said, assuming that the same information as in the question 4, except that instead of the paying the cash, Feel Good Company agreed to issue 5,000 additional share of $10 per value common stock to the shareholders of the Good News. If the average cost combination earning over the next 3 years exceeded 125. So we said that, wait a minute, we are not promising you this cash here. We are not promising you this cash here. But we are promising that we will give you additional shares. We'll give you 5,000 shares if you are able to meet the 1,250,000 every year. Then we are going to give you the shares. We are going to give you the shares. So let's do A, prepare the journal entry. So we can just repeat the same thing that we did here and just look at here. I'm going to repeat the same thing here. I don't know what is going. I will change the liability to stock. So let me see if we can do that. I hope so. Let me see, please. Okay, so let's see. This is a part A. Okay, so we know there's no change in the word. There's no change here. There's no change here. There's no change here, right? Only change come to to the cash and the stock that they are giving here. So they are giving them the stock. Maybe this one, I will leave it. Maybe there was change. We are not giving them cash, so I'm going to take the cash here. I'm going to take the cash here. But rather they are giving them. So here too, let me take this one. Let me take this one here. So one, we are giving them the common stock. We are giving them the common stock. How much stock are you? How much the cash? So we are giving. Oh, it said accept. So we are giving them cash. Let me use that one first. We are giving them the cash, and the cash is the same. 1,080,000. 1,080,000. Yeah. Then we promise to pay them the paid in capital will come from the contingency. We are going to issue them paid in capital as contingency liabilities. Consideration. and we promised them that we are going to give them the stock. So it's 5,000 shares times the what, $10 per value of our stock. So those to the calculator, please. How much we have? Is it 100,000? I think it's 100,000, right? I think so. Yeah, it's 100,000. Yeah, somebody also posted it already. Oh, it's 100,000. Okay. Now let's see whether it's a goodwill or not. So let's see. We know that this is equals to this plus this. There's no change. 1.2, but this is going to be a change.
Professor, it's gonna be a 50,000. It's not
50,000.
100. Yeah, because it's 5,000 shares multiplied by 10 is a 50,000.
Yeah. Yeah.
Okay, I'm coming. You know what? Let me take off this one. Let's see here. It's 100,000. You know why it's 100,000? It's not a, forget about this one here. It's right here. You see, the fair value of the contingent consideration on the date of acquisition was estimated to be 100,000. So let's take this one. We'll come to the next stage. It's 100,000. That's why we put 100,000 here. Does that make sense now?
Yeah.
Yes, Professor.
Okay. So this plus, I like this class. I really love the way you guys ask questions. And so, which means that based on that, we can calculate the goodwill, right? Remember, the goodwill is the difference. So here is now 1,288,000. So how much the goodwill here? Is it 88,000? Is good? Is that okay before you continue? Good. Okay. Now look at the B. B said on the after 2 years, right? After 2 years, they have to see if this company were able to meet the requirement. So it said on 2022, the additional 5,000 share of the Fig Good stock were issued because the end out target were met. So they were able to meet the target. The Fig Good stock price was $50 per share. Prepare the journal entry. So part 2, good news that they were able to meet the target. So we had to hold on into our promise and give them the money. Where is the money coming from? It's coming from the other contributed capital. So we are going to debit the contingency that we created here, but they were able to meet it. So we are going to pay them the money. We are going to give them the money because they were able to meet the standard. So we are going to give them the money. So we are going to debit the 100,000 here. And the promise that we are going to give them 5,000 common shares stock. So we are going to credit the common stock here, which is equal to the 5,000 times $10 per value here, right? Per value here, which is equal to the to the 50,000. So we gain. If you look at this one, we gain. The gain will go to the to the other contributed capital. Will go to the to other contributed capital or paid in capital of the common stock, which is equal to the 100,000 minus the 50,000 of the amount that we are giving to them. So we gain of the 50,000 is is the additional paid in capital that we are getting. Any questions? Any questions?
No question.
Okay, so we are going to finish this one on Wednesday. Next week, Wednesday. There's no class on Monday. We're all aware that there's no class on Monday. So we are meeting a week from today. We are going to complete this one. Then the following Monday, which is going to be somewhere, if I'm not mistaken, 23rd. 23rd of the Monday, we'll go over the practice set for the first midterm. We are going to go over the practice set for the first midterm. I'm going to attend put the attendance, and I want you to check the following students were absent in our last class, which was the Monday. So please, I want to make sure the following students were absent. So give me 1 second. Yeah. So Lopez Camis Lopez here was absent. So I have to send the VOE tomorrow. So this guy, I'm going to drop this person in class. She's absent, he or she was absent. We also have Stephen. Stephen was also absent. I don't know if Stephen is here today. Fazana. Is Fazana here today? Fazana. Okay, I have to drop this student as well. Also was absent. We have that this in Govia was also absent. Green was also absent. Jerry was absent. Carlos was absent. Gomez was absent. And then Richard was also absent. Richard was absent. And then we have Lisa was also absent. So these are the students who were absent in our last class. And lastly, I think one more person, Vanessa was also absent. So let me see if, okay, good, thank you. So Gomez said, Govia said was present. Good, so let me, okay, let me change it. Thank you for letting me know. Okay, so that's it. I will see you guys back on the Wednesday. There's no class.
Good night, Professor.
Okay, good night.